Hi there, everybody. Welcome to Chart This with Dave Keller. It's Tuesday, February 25th, and I am your host, Dave Keller, coming to you from a still quite windy and overcast Redmond, Washington. Thanks for hanging with me. Internet connection, a little spottier than normal here. We've got a lot of wind, which is unusual. We have a lot of trees, which actually is quite normal for this part of the country, but lots of winds and a lot of big pine trees can often create some interesting challenges with power and internet. So thankfully, we've been hanging in there okay. One brief power outage of 4 or 5 hours over the weekend, but other than that, we'll hang in there and hopefully no issues with the broadcast. If I, for some reason, just drop off, please trust that I'm okay and trying to get connected, and we'll jump back live as soon as I can. With that in mind, the market also struggling to gain its footing or regain its footing, as it were. A lot of news to sort of debrief on from a technical perspective. You have a lot of names, of course, previous leadership names struggling. Some of them bouncing kind of nicely, like a Walmart having a nice upside day. Others like SMCI facing removal from the NASDAQ today, unless it can get its annual and quarterly filings filed, which I had not seen news that has actually happened yet, which means that SMCI could no longer be a NASDAQ name as early as tomorrow. So a lot of charts to unpack and review and analyze. And let's get to our market recap. As we look at the market conditions today, bringing up the dashboard here on stock charts, you can see what has become, I think, in a lot of ways, kind of a familiar pattern. The Dow slightly higher, the NASDAQ big time lower, the S&P kind of in the middle. Those NASDAQ names that are down represent a pretty decent market cap, unfortunately. And so the NASDAQ down 1.4%, the S&P down 0.5%. And unfortunately, that keeps us below the 6,000 level. Yesterday, we did close just below 6,000. Today, sort of languishing below those levels as well. Just holding 59.50. We're still about 100 points above the line in the sand that we've been talking about for quite some time, 58.50. We've not broken that yet, but it's getting closer as we have days like we did today. Mid caps and small caps essentially unchanged. Quite a lot of choppiness, particularly in the small and mid cap space. But at the end of the day, essentially no real change from yesterday. And the VIX pushing ever higher. We're now at a 19 handle, about 19.4 on the VIX. That's the highest level we've seen here in quite some time. It's still not above that 20 threshold, which in our opinion is sort of the difference between a low volatility environment, which means not much to worry about, sort of assume that the trends are okay, versus a high volatility environment when the VIX pops above 20, suggesting that there's danger. Someone mentioned aftermarket SMCI up, so we'll take a look here in the after hours trading. Thanks for that, 3P investor, for the heads up on that. We'll take a look when we get to the chart here in a few moments. Looking at the fixed income markets, continuing to see a rotation into bonds, basically away from stocks into bonds, is the general trend that we've observed here in the last week. The TLT, which is a bond ETF, up about 1.7%. Interest rates generally moving lower. I mean, number of reasons why you can sort of cite to explain this, but I mean the general kind of narrative that I'm sort of favor at this point is maybe two things. I mean, I would say the one is, with the consumer confidence number, with the consumer sentiment number that we had at the end of last week, sort of signs that inflation may be an issue, kind of takes rate cuts off the table, and as a result, bonds kind of popping higher. Arguably also a search for yield, I would say, is part of that as well, kind of a defensive kind of flight to safety type of trade as well. It's probably a mix of those along with a bunch of other things as well. The dollar index slightly lower, not a huge change for the UUP, but it did move slightly lower, about 0.4% for the dollar index. And that's important because as we've mentioned a number of times, non-US markets looking pretty strong, particularly relative to the US markets so far in 2025. And some of the strongest charts you're going to find are not in the US at this point, which is a very different environment than we experienced for pretty much the entirety of 2024. You'd be hard pressed to find a non-US market that did dramatically better than some of the best US growth stocks, although they're probably out there, but not common. And I would say this is now starting to feel like a very different environment, what we call a change of character, where all of a sudden non-US markets start to improve on a relative basis. And again, that's very much the trend. Gold actually proving that it can indeed go down, not going up today. The GLD down 1.3%. Silver prices down 2.1%, except for natural gas, the UNG, which is a nat gas ETF. Besides that going up, pretty much everything else was in the red today. Energy ended up being one of the worst S&P sectors today, with weaker crude oil prices being part of that story for sure. Primary uptrend in gold, I would say no change. I mean, it's still a pretty strong uptrend and has handily outperformed the equity averages, with the Magnificent Seven now down year to date and gold outperforming. Still something to watch for sure. Boy, cryptocurrencies not going the right direction, and Bitcoin actually in the last 24 hours has dipped below the 90,000 level for the first time in months. We've been talking about this sort of trading range for Bitcoin over the last couple months, around 108,000 on the upper end, around 92,000 on the lower end. Yesterday, we broke below 92,000 during the day. Today, we got down to all the way to 86,000 before rallying, currently trading just above 89,000. That's still down around 2.4%. You can see most of the top 10 coins actually slightly higher today from yesterday's close, which is basically the end of the 24-hour session for cryptocurrencies. But overall, Bitcoin kind of doing worse than average when you look at the trends here. All right, looking at the 11 S&P sectors, again, similar to yesterday, it was almost the same idea, some different sectors in the different positions, but overall very similar in that it was defense over offense and about a 50-50 split. You can see financials were basically flat for the day. I mean, literally a penny away from yesterday's close for the XLF. That leaves 5 ETFs higher, 5 ETFs lower. So it was pretty much a coin flip here. Consumer staples, number one, up 1.4%. Real estate, number two, up 1.1%. Healthcare, number three, up 0.9%. Those are three fairly defensive sectors sitting at the top of the leaderboard. And again, more and more days like we are seeing today, like we've observed over the last week, is causing the relative performance in defensive sectors to really start to improve. The problem there is that is one of the checkboxes out of the 7 checkboxes I have on my market top checklist. And we've already checked off the first 2. The third and fourth deal with leadership and rotations. One of them would be previous leadership starts to struggle. Hard to, say anything other than that has happened because, you've seen some of those top high-flying names from 2024 struggling. The Magnificent Seven being a particular example of that. And then another one would be an improvement in defensive sectors, which indicates there or implies that institutional investors are rotating to more defensive positioning. And that's what days like today, like days like we've observed for much of the last week, sort of suggest is very much happening here. Communication services and energy are at the bottom of the leaderboard today, both down about 1.4 to 1.5%. Technology, number 3, down 1.3%. And you got a big gap to consumer discretionary and utilities, both down 0.5%. So yeah, today is value over growth, defense over offense. That's the general way I would describe what we saw here. Small over large, you could probably use to describe today as well. What else can we talk about here on the dashboard? Breadth conditions, the NASDAQ breadth noticeably worse than the rest of the market, right? So the S&P is here in the middle, 60% up, 40% down. Not bad. I mean, for the fact that the benchmarks were slightly lower, that tells you that it was some of the bigger benchmarking names, the bigger weights that were struggling the most. The average stock was probably okay. Compare that to the NASDAQ, where 2 out of every 3 NASDAQ names were actually down, 63% decliners there. So the NASDAQ and sort of the growth areas of the market very much diverging from sort of the rest of the equity space here today. As we've mentioned, there's this great widget on the stock charts dashboard. They call it the Keller market model. I actually call this my market trend model, which is basically tracking the major trends on different indexes for the U.S. And there's also a model, macro models, which cover other asset classes. The main one that I use is the S&Ps. And as of Friday, which is when I update the model formally every Friday after the close, so once a week, the short-term model did turn negative for the first time in 2025. It did turn bearish 4 or 5 times through the course of last year. And in 2024, those short-term negative signs were usually a sign of a really good buying opportunity coming in. And that's going to work until it doesn't. And I guess that's a tongue-in-cheek way of saying those short-term buyable pullbacks work as long as dip buyers are coming in and thrilled to buy short-term weakness and ride this trend to the next leg higher. I don't have to tell you that this feels very different for sure. And I'm just in terms of the environment, the macroeconomic environment, what we're talking about with the Fed and expectations about the next 6 to 12 months in terms of whether rate cuts may even happen at this point, just the policy decisions that are happening from the White House and the significant volatility that is creating in the federal government certainly feels like a different environment than we had in 2024. So we'll see. But for now, short-term model bearish across the board on the equity indexes here in the U.S. All right, looking at the Magnificent Seven and Friends. And again, sorry, with your recommendations, we go with the Lag 7 today, which I think is a fair way of describing this particular basket of stocks today, all underperforming the Dow, for example. Amazon, the lone stock that was up, but not much, 9 cents higher on a $200 stock, is up 0.04%, but it didn't technically go down. So let's celebrate a little a minor win there. Apple also essentially flat for the day. Then you get down to some of the names that are really down quite a bit. Tesla down over 8% today. That's the worst performer in this bucket, getting near to $300 a share, which is the level we hadn't seen in a little while. Nvidia down almost 3%. Alphabet down 2.1%. And again, as I mentioned, one of the biggest signs that I've learned from analyzing a bunch of market tops during my career, going back to 2000 and studying some previous tops before there, one of the things you often see is the leadership that works, that creates this bull market phase. At some point, that theme is either over or it changes, or just it's bid up so much that it's so overvalued that all of a sudden people realize that's not the place to be anymore. And so the previous leadership starting to struggle is one of the most telling signs of a big change of character. And I think on days like today, it reinforces with some of the value-oriented areas of the market doing well, and these particular names looking like they are, certainly says, if nothing else, we're getting a leadership rotation. And a number of my interviews, by the way, on the Market Misbehavior podcast have gone through the topics of leadership rotation. My conversation with Julie Stekempener, by the way, was very on point with what we're dealing with here this week, talking about leadership rotation, what may come in to take the place of those struggling growth names. All right, we look at the market carpet. As a reminder, I can't see questions coming in on YouTube, LinkedIn, Facebook, and X, the platforms upon which we are live streaming. I appreciate you guys joining me live, those of you that are doing so. You can ask questions at any point. I'll try to take a question or two at the end of the broadcast. Anything we don't get to, we'll put it in the mailbag. We're planning an all mailbag episode on Friday of this week, and would very much love to feature one of your questions on our show. All right, what do we get when we're looking at the market carpet? So today, it's funny, what I'm immediately drawn to is all the green kind of in the right third of the heat map. And unfortunately for the markets, those are some of the more defensive sectors, and certainly some of the sectors that have been underperforming. These are your leadership sectors, right? Like technology, communications, consumer discretionary. While consumer discretionary is showing some signs of life for sure, I think the most impressive moves that I'm seeing, or certainly the most concentration of greenish colors, are in healthcare. They're in consumer staples. They're in real estate. They're in utilities. They're maybe in materials. So, again, we're seeing rotation away from some of the leadership names from the previous cycle, and now looking like a different kind of feel. I did grab a healthcare stock or two. At this point, I forget which one that I grabbed because I was grabbing them through the course of the day today. But I would tell you healthcare remains an interesting area because I think, again, a lot of those names have been so beaten down, have been underperforming. You're now starting to see a real resurgence in some of those previous underperformers. So again, very much a reversion to the mean of outperformers struggling, underperformers rallying. Consumer staples, probably a perfect illustration of that particular concept. Walmart, which has actually been a bit of an outlier. Walmart and Costco were sort of the two staple stocks that looked like they weren't in staples. They looked like they were probably in technology or something like that. Walmart pulled back quite a bit last week with lowering expectations for 2025. But today, a nice kind of counter trend move higher. I did notate a bit of a candle pattern there that I will highlight when we get to the individual charts, and more to come there. Real estate and utilities, a lot of green. And by the way, I did post a video to my own YouTube channel using the Seeking Alpha platform, looking for high dividend payers and thinking through some of the technical configurations that I observed on stocks paying an above average dividend. We talked about staples, real estate, utilities, healthcare. What was the last one that I had in there? I had 5 stocks. I think it was financials, maybe. Oh no, communication services. AT&T was the last one that I put in there. So if you missed that, make sure you check that out. Some interesting ideas of higher yielding names with some specific technical levels that I'm watching to validate that maybe the price is starting to appreciate as well. Of course, another observation would be some of the red that we see here, of course, in some of the leading names: Alphabet, Microsoft, Broadcom, Meta, Tesla, of course, NVIDIA. Those are all down. So the ones that I'm drawn to are the ones that were not down: Amazon and Apple, right? Those are some of the stocks in those growth sectors that actually managed to hang in there okay, have a flat day when everything else is down. And I think that means something, right? What you have to remember, as we mentioned many times, what I love about the market carpet, as it's called on stock charts, or any kind of heat map kind of visualization, it helps you identify outliers. I think a lot of times if you invest in individual stocks, it's not about picking a chart and getting the analysis right. It's deciding which chart you should be looking at in the first place, right? Scanning, alerts, using visualizations like this to really just focus on, all right, out of all the hundreds, if not thousands of stocks I could look at right now, which are the ones that present a potential opportunity? So on a day when the benchmarks are down, I look for things that are bucking that trend and are actually improving. If in sectors that are struggling, like technology, I look for stocks that are actually up to think about, all right, what is making Cisco still look like nothing's wrong? Because the chart of Cisco still looks pretty good, making higher highs and higher lows with no real interruption to that trend. Maybe there's something there, right? Maybe there's an opportunity to outperform the rest of the technology, which is clearly struggling a little bit more. So that's sort of what I would think about here. And again, quite a bit of rotation here. And to someone's point here on the chat, Tony, thanks for mentioning money not leaving the market, just rotation. I would wholeheartedly agree at this point. Although you are seeing bonds rally pretty significantly, which means something's moving over there. But I would tell you, yeah, I mean, on really negative, washout, doomsday, the market's going down. I'm talking like, great financial crisis kind of days where you go in and everything's down. Literally everything's down. You don't see any green, or if you do, it's just a tiny little specks of green because pretty much everything's going down. That indicates a big rotation away from equities into some other safe haven. Here, you're kind of seeing the tables, road. You're literally like seeing the flows from the left half to the right half in a lot of ways, right? From the growthy stuff to the value stuff. Get really concerned when this is a bright red to light red kind of configuration. And all of a sudden it looks like we changed the color scheme to some horrible other, reddish lavender kind of thing. Wait for the heat map to show you that things are really getting ugly. And that's when it tells you investors are going full risk off and just trying to get out of equities as much as possible. We're not seeing that yet. We're seeing it rotate into other areas of the market. Unfortunately, areas of the market that are much lower weights. So the benchmarks are going to be down if this is what the heat map looks like, just because the biggest stuff, the biggest growth names are the ones that are down. That doesn't help the benchmarks go higher. All right, before we get to the charts, I do want to remind you, last call for our February webcast. We're going to be doing a webcast tomorrow on Wednesday, the 26th, 1 p.m. Eastern, 10 a.m. Pacific, called Finding Value, the Great Rotation of 2025. If what I just talked about piqued your interest and you want to dig more into what's happening, into some of the charts that will help us more clearly define that rotation and focusing on where we see potential opportunities on which stocks and groups are improving while other things are struggling, you want to join us for this event. You can sign up for free at marketmisbehavior.com/value. You can scan the QR code that you see on your screen. If you're watching it on our YouTube channel, there's a link in the description below to sign up for that free event coming up again Wednesday, February 26th, 1 p.m. Eastern. I hope you will join me there. It'd be great to have you. All right, looking at the chart of the S&P, obviously another distribution day. This distribution really started mid last week. We made a new all-time high, touching 6150 for the first time in history. And from there, we have come down. It's not quite a free fall, but it's pretty close. You can see the S&P just barely stayed above 5,900, ended up closing above 5,950. We're getting closer and closer to this thick purple line. I should probably make that like a bright red line or something that seems more foreboding or more concerning. And now I'm realizing I still have that image up. There we go. Now you can see the charts. What I was saying here, sorry, the S&P holding at 5950 after trading almost down to 5900 a little bit earlier. We are holding above my big purple line, which I maybe should recast as a bright red, maybe more dangerous color than neutral purple. But basically 5850 is that line in the sand we've been talking about, really going back to, November. Because during an uptrend phase, what I generally do is kind of bump up your stop, right? And every time we make a higher low, you kind of bump up that, sort of stop, that level that would tell you something's different. And the reason why you do that is because Charles Dow tells you an uptrend is a high pattern of higher highs and higher lows. When we stop making higher lows, that suggests that maybe that pattern is changing. And at the very least, it's like a wake-up call, like, uh-oh, let's review and see if something's maybe getting a lot worse. That's why in early January, we noted that break below 5850, and we definitely raised a red flag and thought, all right, this is a potential beginning of further deterioration. We didn't see that follow through that would have validated that breakdown. As a matter of fact, from the breakdown, we had a series of higher closes before a gap higher above 5,900, which was again right about where we hit lows today. A bit of a concern. So you call that a failed breakout above 6,100. At least that's what I would call it. About 2 weeks ago, we're now back into the range. We're back below the 50-day moving average, which is sloping lower for the first time since, yikes, I don't know, probably July, August of last year. It's been a while since we've had a downward sloping 50-day. And again, that's not the end of the world, but it definitely tells you things are changing here. Generally the way that I approach a market like this is you define a line in the sand. For me, 5850. As long as we hold that, it's noise, it's natural movement, it's fluctuation, but it's not a huge signal. S&P below 5850, I would argue, is a signal. That's where you have to start to question, general risk appetite and whether you want to start to lighten up on positions and get more defensive overall. Small caps not doing particularly well today. The small cap Russell 2000 ETF popped up on my alert yesterday for breaking below its 200-day moving average. Popped up on my alert today because it briefly undercut this low from January. Ended up holding it. We closed just above 215. But the IWM, I think the S&P looks like it's distributing. Take a look at small caps, right? This looks like a complex head and shoulders kind of pattern. It's not perfect because it's not a perfect head, and there's some weird aberrations on the left side. But, generally, you certainly saw a move to new highs and now back into a similar range. So it does have that symmetry that is pretty common with a head and shoulders top. Breaking below the 200-day, which it's been above since November of 2023, does not give me a warm and fuzzy feeling about the strength of small caps. The fact that the most recent rally phase took us to the 50-day moving average, which continued to slope lower, and the RSI stalled out before you'd even got to 60. All of those things that I just mentioned tell me about a chart that has rotated from accumulation to distribution. Now, the problem is small caps have not been a great relative bet for quite some time, right? Look at the relative performance on the bottom. With a couple notable exceptions, overall, the general trend is down, and we're making a new, relative low this week. So on a relative basis, large over small has been the story here for a little while. And I would say now you're actually seeing small caps break down even further into a more concerning degree than we're seeing with large cap stocks just yet. Now, before you go saying Dave's ultra negative, we're breaking down, I would remind you we're still holding my line in the sand at 5850. My medium-term market trend model is still bullish. So I don't see, get out of the way of this freight train kind of signals just yet. One of the reasons why I would say we're not there yet in terms of like full panic mode is while breadth indicators, don't get me wrong, have not been great. And I would say there's a concern for sure that every time we've made a new high since the end of September of last year, we've done so on weaker momentum. That's not a healthy bull market kind of look for breadth, but we're still holding about 50% of S&P members above their 50-day, right? Like a lot of stocks have not broken their 50-day in the last week. Most S&P members remain above their 50-day, even though the S&P failed to hold its own. 60% of S&P members are above their 200-day, right? So most stocks are still in a primary uptrend as measured by the general configuration of their moving averages. When that changes, which is why I think this is a type of chart to watch very, very closely right about now, that's when I think you start to get concerned and start to take deliberate action. Not quite there. Tell you a place where deliberate action could certainly be warranted is with cryptocurrencies. Bitcoin, with today's breakdown, finally resolving this basing pattern to the downside. We've talked about this range from 108,000 on the upper end, 92,000 on the lower end. That's the framework we've been in really since late November through mid December. We sort of initially set that range, and then from there we've just been kind of retracing those levels. The 50-day moving average has been flat for the last 6 weeks, representing or really confirming that sideways range-bound market. In a range-bound market, there's no real indication ahead of time necessarily as to which way that pattern is going to break. But today, it certainly indicates that the pattern is breaking to the downside for Bitcoin. Now, when you have a big break of a key support level, like I think we've seen, it's all about follow through. It's all about tomorrow when we circle back and review the chart of Bitcoin. Have we had a nice reaction, a nice bounce, indicating that people are buying up on the weakness in Bitcoin? But for now, it's certainly a concerning breakdown. So again, while the S&P has not broken its line in the sand, I'm seeing more and more charts breaking their line in the sand. Other risk assets that indicate or at least suggest that investors are rotating to like the safety of the S&P and away from some of these other riskier assets. That's not a good look. So I would argue with that breakdown, assuming it's confirmed over the next day, primary trend in Bitcoin now down after a consolidation phase going back to mid-November. And full disclosure, I do still own Bitcoin. All right, looking at the TLT, quite a bit of a change of character here in the last week. We talked about the rally that we saw from early January through mid-February, really trading right up to a beautiful trend line, taking the September 24 high, the December 24 high, the February 25 highs, and all of a sudden over the last couple of days, we have now broken that to the upside. That was Friday when we closed above that trend line for the first time, and then Monday and now today continue to gap higher. So you're certainly seeing a surge higher in bond prices. This rally takes the momentum finally out of the bearish range and suggests a rotation more to a bullish phase. So you're getting a very kind of similar feel to what we saw back here. You know, if you look, very similar kind of the general trend of where we had about a 6-month downtrend, very similar. We broke above trendline resistance. That ended up being the beginning of a pretty good rally in bond prices. And while I can't guarantee we're going to have a parallel move after that break, it certainly tells me we're in a similar configuration where rates are coming down and bond prices are going higher. Here's the chart of the 10-year yield. It's essentially the TLT flipped upside down, and you can see the gap lower today in interest rates. 10-year yield now all the way back to 4.3%. All of a sudden down to about the midpoint, almost, not quite, about the midpoint of the September low to the January high. You can see the 200-day moving average, which is where we bottomed out last time in December, now a little bit below current levels. But overall, I would say the general trend in rates is lower at this particular moment. I think those trend line breaks are pretty important to follow. I mentioned the video that I did earlier on my YouTube channel talking about dividend investing and dividend plays, thinking about some areas of the market that are lower volatility, higher income component. This is one of the charts that we started with, which is basically focusing on the improvement in relative performance of defensive sectors. I mentioned this earlier in today's show as well. Here's the relative performance of utilities outperforming the S&P year to date. Here's the relative performance of healthcare, of consumer staples, of real estate. All 4 of those sectors have outperformed the S&P 500 so far in 2025. And, you know, something like consumer staples, which have just been chronic underperformers. I mean, it's been hard to find, you know, except for like Walmart and Costco, which have been, you know, sort of outliers, tobacco names, which at times have done very, very well. The average consumer staple stock, if you look at like food products or cleaning products and things like that, have been absolute disasters on a relative basis. Now starting to change. Now it could be early on in that, and that's why I think it's important, right? Focus on charts within that sector that are starting to improve. Look at, you know, think about what signals would tell you, okay, this is enough of an upside move that maybe I want to bet on that trend continuing and get a little more defensive positioning with that rotation. I would say the improvement in relative performance is a danger sign for the major averages. This is one of the things that, you know, kept us kind of bullish in Q4, just sort of saying we didn't see any negative rotations yet. I think you're seeing some negative rotations right about now. What a decent time to update the old performance chart here year to date. Gold with the big down day still up about 11% in 2025. Bonds now overtaking the major U.S. equity indexes in the last week. The TLT up 5.1%. The equal weighted S&P is up 2.8%. The S&P 500 is up 1.4%. The NASDAQ just barely above flat at positive 0.4%. Here's the MAGS ETF, which is down 5%. So, this shows you the change. We talk about a change of character. How about one of the leading, themes, if not the theme of 2024, getting completely crushed? Bonds, which have not been doing particularly well on a relative basis, all of a sudden starting to improve. Gold has actually been in a driver's seat for quite some time, but that is the configuration. That is the change of character, sort of the alligator jaws opening up is what you see here, overall indicating continued rotation away from mega cap growth. All right, let's look at some of those growth names and others. Chart of Meta, I mean, how bad does it look right now? I mean, still not horrible, right? And I think that's the reality with charts that have done so well for so long. And when they're so far away from moving averages, they can pull back quite a bit and still be within what we'd consider a primary uptrend. Take the December peak, which is around 640. That's pretty much the low from today's action. So we're pulling back to a key pivot point. We're testing the 50-day moving average, but we're still holding it. The RSI is still holding 40. I would say from a technical perspective, while the last week and a half has not been particularly comfortable, overall, this is still a chart in a primary uptrend based on the premises of technical analysis that I use. If we break below 640, that would mean a break below that pivot point, below the 50-day. The RSI goes below 40. All of a sudden, this is less of a constructive chart and looking more like a chart very much in a distribution phase. Amazon has broken below its swing low from January. That was around 216. We highlighted that level as a resistance level from November. That became support in early January. We made the new all-time high just above 240. And from there, we've come down. So you can see that Amazon actually started to sell off before something like Meta. It sold off right at the beginning of this month. Today, what I think you would have to describe as a hammer candle. Let's make it a candle so we can see what's going on there. So here we can see a hammer candle. Hammer candle is basically where you're in a downtrend, and then you have this pattern where the open and close are near the upper end of the range. There's a limited upper shadow and a long lower shadow. That's a bullish one candle pattern, basically suggests distribution. All of a sudden, it's sort of a V shape to the day today because we open, we trade much lower. By the close, we're all the way back to eclipse the opening price. So short term, suggesting a bit of an Amazon bounce here through the next couple sessions. Does that end up being a dead cat bounce as we near the oversold level, or does it really start to be the beginning of something more significant? That's what we don't know for sure. But certainly suggests at least the acceleration to the downside that we've experienced. Probably going to hit pause on that over the next day or two is what that chart would tell me based on the candle pattern. All right, let's continue on to Tesla. Tesla, no hammer candle in sight. If you're looking for a nice bullish, optimistic view on Tesla, it's the wrong channel at the moment because the charts are telling me this is in a primary downtrend. Lower lows, lower highs. We're below a downward sloping 50-day moving average. The 200-day, which is currently around 277, getting closer and closer every day like this. We are oversold for the first time since April of last year. However, I'm pretty happy being patient. And in this kind of chart pattern, I wait for signs of accumulation. You're not really seeing it. You're seeing counter trend bounces, but you're not seeing any significant rotation higher. Tesla down another 8%. And I would say the chart very much broken at this point. Super microcomputer. We'll look at the after hours trading here because I do want to see what happened. So this was the big deadline. If you missed this, oh yeah, we're up quite a bit here. So it looks like I'm going to go ahead and assume they got to the filing because basically when they missed their filings at the end of the year. And so the NASDAQ gave them until today at the end of business to file their annual report. And if they're unable to do it, they're going to be delisted. It certainly seemed to me like high likelihood they would actually do it. And the CEO, if I remember, some upper manager of the company had mentioned they were pretty confident they would be able to make that deadline. That wasn't today, that was earlier. But for now, it looks like SMCI up about 23%. Now, here's the bad news, SMCI fans, is that still only gets you right about to there, right? 56 or so. So we're still just within yesterday's range. However, this has been a steep sell-off as all of a sudden it looked like they may miss that deadline. So What's interesting about the chart of SMCI going into the close that I didn't know as I'm drawing these trend lines, didn't really know what was going to happen with the filing. But we've talked about this inverted head and shoulders pattern, not a perfect one, but, certainly had that configuration. And if you draw a neckline using the October peak and the December peak, that gives you this level. So the breakout a couple weeks ago was pretty meaningful. We pulled back today, and today's low was almost exactly on that neckline. So if we do get a bounce here tomorrow, which looks pretty likely, and we bounce off of there, maybe this is a natural test of that neckline support. And I would say as long as that holds here in the days to come, chart's okay. We break that, and all of a sudden it starts to feel like we're retracing into that pattern, further distribution. So good news for SMCI. It looks like that was for now a bit of a win today. Home Depot actually holding a key necklines, right? So we talked about this head and shoulders topping pattern. I mean, textbook kind of classic pattern, even in terms of the duration. It's about a 4-month pattern. That's pretty standard. You have the head, the left shoulder, the right shoulder, very symmetrical. You have a neckline right around 380. We traded below it yesterday, but didn't close below it. We traded to the 200-day moving average, but did not close below it. And in that scenario, I would tell you 100%, wait for a break of that neckline, the break of the 200-day. That's the signal. We didn't get it today, actually bouncing higher, a nice counter trend move off of those lows. So for now, the neckline is holding. That is a key line to be watching through the course of the week. I'm reminding myself to set an alert on Home Depot for that one around 380, we'll call it, and watch to see if and when that would break. And if and when it would, that would be the third leading consumer discretionary stock to be struggling quite a bit. All right, Walmart. I just wanted to show this one because this is a bit of a candle pattern. This may be one that you're less familiar with. This is actually called a Morning Star candle. I should have asked you if anyone knew what that was, but sorry, I ruined the suspense. A Morning Star candle. I tend to think of a Morning Star candle as making sure the bodies of the candles don't overlap, and I think technically we're clear there. But a Morning Star candle is where you have a down day and an up day. Think of it like, but a day in the middle where your sort of open and close are near one another. Think of it as like a bullish engulfing pattern with kind of this, extra bonus day in the middle. So it's a big down day. We wait. A big up day. So if you ignore the middle candle, it looks like a bullish engulfing pattern. But that third candle in the middle with the open and close near one another, this makes it into what's a 3-candle pattern called a Morning Star candle pattern. It's a bullish reversal candle pattern, basically saying we've sold off. We're in a downtrend. We have a big down day. This means maybe the down day is lightening up a little bit, kind of looks like a hammer candle of sorts. Then you have the big up day on day 3, which suggests we're now seeing an upside rotation. So actually a bullish short-term sign from Walmart. And again, the problem I have with charts like this, with any of the other names that I mentioned, like an Amazon having a bit of a bounce, is this a dead cat bounce? Is this just the short-term bounce before the next leg lower? And in any of those, I would keep a close eye on the lows of those candle patterns. That's usually an important one to watch. So on, I think it was Amazon with the candle pattern. Watch today's low as an important level to confirm that the hammer candle is not working. I would say with the chart of Walmart, line on the sand for me is 90. I don't know if I have that alert set. I'm going to do this. And what I'm doing, by the way, when I set alerts, this is literally what I do all day, is if I see a pattern and I see a clear line in the sand, I usually go right in and set an alert. I don't want to do it now to ruin the vibe that we're working on here, but that's what I would do. And again, when you see charts like this, whatever charting platform you use, let the chart do the work for you and let you know when you need to revisit the chart of Walmart because 90 is not holding. That's the line in the sand that I'm watching. Last chart, then I'll take some questions. Walgreen Boots Alliance. This is not one of those dividend-paying names that I mentioned in the video that I released earlier on dividend plays for February 2025. Although I'm looking, it's almost a 9% dividend yield. Now, the reason why that dividend yield is so high, besides the fact that it's a decent dividend, it's the fact that the price has come down so much, right? So 2 years ago on an adjusted basis, this is trading around $30. Now it's around $10, $11. So that's a big haircut in terms of the price. And so the dividend that you get per dollar that you're throwing in for buying the stock, the dividend is just worth more in terms of a percentage of the share price. However, I think what's interesting here is sort of this rounded bottoming pattern, right? A clear downtrend for WBA for most of this chart is marked by a pattern of lower lows and lower highs. And look here in November, we no longer made a lower low. All of a sudden in probably January, we're no longer making lower highs. And all of a sudden we're making higher highs and higher lows. That's the kind of rotation from distribution to accumulation, getting back above the 200-day moving average. As long as we hold that, higher low, maybe this is the beginning of an upside rotation in one of the many beaten down names in the consumer staples sector. All right, someone confirmed a Morningstar pattern. I agree. We'll call it that for sure. All right, what else can we do? Akira, thanks so much for watching on YouTube. I recognize your name from previous episodes. You said, would you consider Tesla and Palantir showing a bearish engulfing pattern? What could be some pivot points to consider? Interesting question. Let's take a look here. It doesn't jump off the top of my mind thinking a bearish engulfing pattern. But let's take a look here. So what would you be referring to necessarily, like on the weekly chart? No. So I don't really see a bearish engulfing pattern. What a bearish engulfing pattern would look like is kind of like here, I'll make it a candle chart so it's a little bit easier. So bearish engulfing pattern would be, let me see a good one here. Of course, I don't have a great example. Let's see, something like Apple would be a better one that has a bunch of those. Let's see. Nope. NVIDIA. What stock am I? Someone guess what? Here we go. NVIDIA. I was going to say it's one of these stocks. At some point, I'll find it. Here we go. Bearish engulfing patterns have happened a lot on the chart of NVIDIA. That's where you have an up day and then a down day. Day two's body engulfs day one's body. That's a bearish engulfing pattern. I don't see that on the chart of Tesla by any means, to be honest with you. So I'm not sure exactly what you're referring to. On this one, but no real candle patterns that I would say on the chart of Tesla here. You may call this like a 3 black crows pattern. That's an interesting idea. But you'd have to see, an upside reversal after that to kind of validate that. And if I remember right, that's really something that happens in an uptrend. Is that true? I'll have to dig into that candle. You're making me think of things deep in the candle repository in my brain for sure. Let's see. I won't attempt to pronounce your handle, but I appreciate you watching. Is it true that an easy way to tell if this is more than a correction is if we trigger the 5% canary signal? Here's the thing. I am familiar with a lot of people that have those kind of rules that have like a, 5, if we go 5%, it's X. If we go over 10%, it's a pullback. If we go over 20%, it's a bear market or correction. And I don't even know the labels because I'm not a huge fan of that. For me as a technical analyst, I feel like that is a shorthand that is super helpful if you don't look at charts. If you never looked at charts and could just easily have a spreadsheet that say, tell me when any things are down at least 10%, that tells me they're in a correction, then I wouldn't have a problem with you using that. But I would say the technical analysis toolkit has such a rich library of tools to tell us much more effectively and much more systematically, or I guess statistically relevant as to when a trend is changing. I'd much rather, instead of thinking of a particular percentage threshold, I'd much rather look at support and resistance levels, lines in the sand, RSI, momentum levels, volume, relative performance. All of those things I think are much better at qualifying, is this just an initial pullback or something that's really getting worse? For me, that RSI 40 level is an important one that I always like to watch. As long as the RSI holds 40 on pullbacks, there's just not that much to be worried about, because what that tells you is, based on how the chart is normally trading, we're just not selling off enough that we're probably in any sort of danger from a technical perspective for that particular chart. When we sell off and the RSI breaks below 40, well, it doesn't guarantee that we're in a big downtrend. It does tell me that we're no longer in an uptrend, and I need to start maybe considering analyzing to see if there are further breakdowns. For me, a line in the sand technique, I don't really know, glancing at the chart, if this is a 5% move or a 12% move, but I know that 58.50 is pretty important. So it's a different way of thinking of it. Those shorthands of 5%, 10%, 20%, I think are more, if you're not a chart person, I get why those would seem really valuable, because it would help you, if you're looking at a big table of numbers, to identify which things are breaking down off of their highs. I think charts are a much better way of doing that. I would say one interesting exception is Dave Landry. He has an indicator called the TFM 10% system, and the TFM stands for trend following moron. His approach is just like, don't make it too cute. Don't make it too complicated. When something's 10% off of its high, get out of the way. And he's got some great studies that are built into the Stock Charts ACP platform. Pretty sure that's a free plugin you can get if you're a Stock Charts member. It's Dave Landry's plugin, and includes that indicator. And again, that is one maybe that I would use because I've worked with him and looked at it and seen the examples of where it prevents you from participating in big downdrafts, which I think for a lot of investors is kind of the game. Folks, cannot thank you enough for watching live. Those of you that are, those of you that are watching the replay on our YouTube channel, I appreciate you as well. Please keep the great questions coming during our broadcasts and or on the comment section of our YouTube channel. We're planning an all mailbag episode on Friday of this week, and we would love to answer your questions. Some really good episodes of the Market Misbehavior podcast have been posted recently. Most recently, Ben Emmons talking about the Fed. And I think that was a really interesting one going into some of the economic data that's been released over the last week. Also captured some really good interviews at the Money Show. I'm still trying to get the audio video footage so I can release those. But as soon as I get them and can turn them around for you, I will do so. But some really good conversations to share with you there as well. I will hope to see you on tomorrow's webcast, which you can sign up for that at marketmisbehavior.com/value. And I wish you a very good night. And remember, it's always a good time to own good charts. Have a good night, folks.